range for the market continues to be higher, and it seems like 25,000 for now at least is a solid base. What do you think is actually going to move up from here? Any sectors that you're betting big on?
Hi, good morning. I think, as you rightly pointed out, Big Bang GST and post that, I think we've seen the market stabilizing and a lot of short covering also we've seen from the FIS front. And maybe the figures in the cash markets also have started moving on upward side, and we've seen a couple of days, positive days as well. So I think looking at the markets, I think it's going to be a stock-specific markets, unlike what we had for last 2 years. The euphoria was there. So I think, going down to what we can make out from the Q1 earnings also, I think there were a lot of stock-specific. Overall, the Nifty earnings, if I look at it, or maybe of the broader picture, Nifty 500 earnings also, they were broadly in line with what the street estimates were or our estimates were. So my sense, I think it will going to be a more stock-specific sectors maybe do well, but from the just to give you a perspective, I think the clear leader for this rally looks like, I think, cement. The numbers of that sectors, the numbers have been robust across most all the companies, large caps, mid caps. All the numbers have been pretty robust. So my sense, I think cement will continue to do well. The earnings were very good. So I think Ultratech leading from the front, and I think looks like another 18% upside in Ultratech, followed by, I think, banks. I think ICICI, State Bank, HDFC, all three large banks reported a blockbuster numbers. So again, those will continue to do well. Then here and there, I think metals, I think post the safeguard duty on a steel, what government has given, I think that again will rebound the cycle. And then we've seen whenever such actions have taken in past, the stocks have done much better, and at least 30-35% of the return in following years. So my sense, I think steel stocks should do well. Domestic cycle is also improving. So I think, and plus the GST push the consumer stocks, I think, which were laggard for the last couple of years. I think we've seen the traction in that. Secondly, I think if you look at FMCG numbers in this quarter, most of the managements have been talking about the volume growth in rural and as well as urban. The large players like HUL. Then if you talk about the consumer paints companies like Asian Paints, the management's commentary was strong. So on and on. So I think it's going to be a stock specific. Looks like market's not going to fall much. Maybe the downside is protected because of the domestic macroeconomics very strong. Maybe we might see some kind of global noises which might lift down the sentiments for temporary. But I think looks like market's not going to fall much. Maybe 1-2%. Maybe or the downside could be 1-2% from here.
Okay, so that's the take on the market, and seems like the bottom is protected as of now, like you said, Rahul. But like you were indicating, earnings momentum expected to pick up going ahead. We also now have more clarity on the GST slabs. What we still don't know is what's going to happen on the 27th of August when that secondary round of tariffs comes into play. So how does one navigate the market with this uncertainty still with us? Because all else, like you mentioned, still looks good.
So I think, as you rightly pointed out, I think that's what also I mentioned, that I think the global macro is going to, global noises is going to create some noise and volatility in the markets. So domestic earning cycle has been, if you look at the macro indicators for the domestic fronts have been pretty strong. Now, coming back to the 27th, I think that's no one's call, I think, in terms of this. But I think what we can gauge out of it and what we feel about it. So I think looks like, I think the stocks which are least affected is, I think, from where we have a domestic story where, the sectors like power, which is domestic, consumption, which is domestic. So maybe retail finance, retail credits, and post GST push for the retail consumer momentum. So I think, so maybe in auto to some extent, which we've already seen for good rally in passenger vehicles as well as two-wheelers stocks. So all these things will benefit, but I think that's no one's choice, I think. But one should focus on this stocks which is going to be at least impacted is where the domestic economy related stocks.
The railway stocks once again are going to be in focus. Look at a Texmaco Rail. They've bagged orders worth about more than 100 crore rupees. And then Titagarh Rail as well, which has actually secured a 467 crore rupee order from GRSE. So these two stocks are going to be in focus this morning. Rajesh, what is your reading on the charts? And do you think railway stocks can make a comeback?
Also, not much has happened in the last couple of months, but if we see both the counters, Texmaco Rail or Titagarh Railways, so both are trading around its April swing low, from where we had seen some traction. So around those levels, we have seen some positive momentum during this week. And since indicators are a bit oversold and some kind of positive divergence are there, we can expect some trading bounce. Like for an example, Titagarh, if we see somewhere around 800 levels, a base formation is formed, and in the near term, the stock can rebound to its 200 DMA placed around 930. So a trading bet can be taken. Similar, if we say Tex Rail, it is taking support around its May swing low, around 130 levels, and from here onwards, the stock can bounce towards its 89 EMA placed around 155. So not from a positional point of view, from a trading point of view, definitely a trading bounce is expected in the near term.
Okay, so that's a take on some of these railway counters. But another stock to watch out for today is going to be Vedanta, all set to pay its second interim dividend of 16 rupees per share for FY26 to its shareholders, which roughly amounts to 6,256 crore rupees overall. The record date for the same is 27th of August, and Sharad is joining us with more details on this dividend announcement. Sharad.
Important announcement coming for Vedanta as they have declared a second interim dividend of 16 rupees per share for FY26. The first dividend, the number was 7 rupees per share. So the total dividend for this year itself is coming in at 23 odd rupees. Now, so the new dividend announcement, there would be an outflow of almost 6,256 crore rupees, and the important record date for this would be August 27. The dividend history so far, FY24-25, it has been above the 40 mark, and in FY23, it was an outlier with almost 102 rupees per share of dividend being given out. Net, the dividend yield comes in at 12% for Vedanta as per our calculations, but there is a benefit coming for the holding company Vedanta Sources, as they own roughly 56% in the company, and they are expected to get roughly 3,528 crore rupees in form of dividends announced on this. Also, the recent hurdle was there for Vedanta, and despite that, they have announced a strong dividend payout. NCLT deferred the hearing on demerger matter to September 17 after concerns were coming in from government agencies and SEBI as well. But going ahead, the strategic priorities for the company in the coming years will be the timely completion of all the capex projects, the continued deleveraging, and lastly, the interest rate cost reduction.
Okay, that's that on Vedanta. A bunch of stocks which are also going to be in focus this morning, given that Vedanta has now approved the second interim dividend, 16 rupees per share for FY26. Apollo Hospitals, wherein the promoter is offloading that 1.25% stake, and it's going to be as sizable as almost 1,400 crore rupees. That's going to be the chunk of the block deal that one is going to see. But again, Rahul, when you look at the entire healthcare space, and especially Apollo Hospitals, sitting on solid gains, it's the most go-to name within the healthcare pack. Where else, if at all, outside the list of Apollo, are you finding opportunities to buy or even add to the existing positions? Rahul?
So I think if you look at it, the entire healthcare space, I think, has done quite well. And I think if we look at it in terms of most of them, and recently listed as well, I think all of them have done quite well. So my sense, obviously, the top of the list in a large play will be Apollo. And I think reasonably valued also compared to others. So my think top of the list is Apollo definitely, plus the post-demerger also of their online businesses, which will also add value to shareholders. So I think top of the list, Apollo, followed by Max Healthcare. Again, that's one also what we've been liking in that space. And then vis-a-vis all, we can have a small stake.
A little bit of a patchy line. Okay, I believe we've got Rahul on a little bit of a patchy line. We'll try and reconnect that. In the meanwhile, Rajesh, give us a chart check on Wipro, because today there's a news flow coming in on Wipro wherein they've bought ER&D firm Harmanjeet Connected Services for a whole lot of 3,200 crore rupees. What's your take on the charts and any other IT stock that you like at the moment? Or is Wipro looking the best of the lot right now?
Yeah, so if we see IT space overall, so Nifty IT space is trading on its 200 weekly moving average, and from there we are seeing some kind of bounce in this week, and we expect this bounce can continue, and the IT space is trying to catch up with the broader market rally. So we are positive on the IT space as concerned from a trading bounce kind of view. If we consider Wipro is also looking positive. The stock is trading somewhere around 252, and on the lower side 240 has been acting as a support since May month. This week also 240 acted as a support, and we are seeing a reversal. So with a stop loss somewhere around 240, Wipro can be bought. We are expecting a bounce towards 260 to 265. The stronger counters are Tech Mahindra and TCS. If we consider Tech Mahindra, it is holding on to its rally seen from the April swing low. It has just corrected 50%, and it's still holding on to its 200 EMA. So Tech Mahindra is what we are bullish on. We are expecting Tech Mahindra to move towards the levels of 1650 to 1680. The second counter which we like is TCS. If we see 3000 has been a multi-year swing lows, and this week also there's some kind of bounce from the 3000 levels, and bullish engulfing formation is happening on this level. So from here onwards we expect a bounce towards 3250 to 3300. So with a stop loss of 3000, TCS also can be bought.
Okay, that's the take coming in on some of the IT names. But here's an interesting bit of news, and sources tell ET now that SEBI has actually raided trading guru Avadhoot Sathe's Karjat Academy in a crackdown on finfluencers. And my colleague Ankur Mishra, who's been tracking this story pretty closely, joins in with more details.
Yes, sources say that market regulator SEBI has raided the Karjat premises of educator Avadhoot Sathe, and this has happened on August 21 morning, and it continued on August 21 as well. Now, allegations are that although he was educating through his platforms, but he may be promoting few of the stocks, few of the illiquid stocks in the name of education. Remember, there were norms which were released by market regulator on influencers on saying that any of the SEBI registered entity cannot be associated with any of the influencers. Although if you talk about education, that was kept separate, but now we understand that few of the complaints have been received against Avadhoot Sathe, and therefore market regulator SEBI is acting on those complaints and investigating Avadhoot Sathe. Now, in that search and seizure, we have been told that few of the electronic devices of Avadhoot Sathe has been kept by market regulator, and that study may continue for a few days whether or not these allegations are right. But for now, market regulator is going very hard on influencers, on these kind of influencers which are impacting small retail traders, and hence now a fresh action has been taken on them.
All right, thank you so much, Ankur, for getting us all those details. But getting back to the markets then, and we also have Dharmesh Shah with us, who's the head of technicals at ICICI Direct, joining us on the show. Hi Dharmesh, morning, good to be speaking with you. So Dharmesh, we are seeing good moves on the benchmark indices today. Of course, we'll see where the index is headed, but sectorally, how is the picture looking like, and help us understand which sectors do you believe can outperform the rest?
Yeah, good morning. It's definitely, I think the mood seems to be get changed after the Friday announcement of GST rate rationalizations. We believe, I think, so look positive for the market. Yes, intermediate corrections are the part and parcels of the market, but it looks like if you look at the market breadth, I think so that's a good indicator to understand the market. The percentage of stocks trading above 50-day moving average last week was around 27%, 43%. Currently, it is around 42%. So there is some bit of a major improvement in the market bet in terms of the percentage of stocks of total CNX 500 trading above 50-day moving average. That is one way to look out for. Apart from that, Nifty seems to be witnessing a falling trend and breakout on the shorter time frame, indicating some bit of a end of the corrective phase in the near term. So yes, we believe I think so the market we see a bottoming out formation in this range of 24,200 to 24,500, and eventually we expect in the near term market to head towards 25,400, which is again the 80% retracement of this entire fall from 25,700 to 23,900. Then 24,200, that is something around 80% comes to around 25,400. So 25,400 remains to be our strong target for the near term. But apart from that, strong support is placed at around 24,700. So buy the dip should be the strategy going forward. As far as sectors are concerned, yes, we remain to be constructive, positive for banking. Again, banking is something which is very near to its lifetime high. We expect Bank Nifty to challenge the life high in the month of September. Apart from that, banking, again, we remain to be constructive, positive for hospitality, hotel space, defense, I think so the one which has seen a good correction in this recent corrective phase. We believe I think so there could be a more of a bottoming out formation for defense stocks from the current levels, and we should see a gradual up move going forward for defense space. Last but not the least is metals. Again, inverse correlations with the dollar index. We believe I think so the dollar index should break 98 and should be looking for a target from 96 half. That augurs well for metal as an index, and we believe the most of the stocks seems to be on the verge of a breakout, whether to talk about Tata Steel, JSW Steel, or Jindal Steel and Power. So metals is also the one sector which will remain to be positive in the near term.
So Dharmesh, morning. These are all the sectors that you're liking, but what about some stock-specific recommendations? What's made it to your radar today?
Yeah, as far as stock-specific recommendations are concerned, we remain to be positive for auto space after this announcement, and I think so we remain to play with more for proxy to the auto. I think so that is something auto ancillaries where tire stocks looks more positive. We are expecting I think so growth in the OEMs. I think so the tire as an industry should be the biggest beneficiaries of the all. The Apollo tire remains to be a top pick at the current market price of around 462. I think so we expect the stock to head towards 519, keeping a stop loss of around 419. Again, for Apollo tire, the strong base on, if you look at the auto index as a whole, it seems to be on, has witnessed a breakout from the inverse head and shoulder, indicating, I think so, a long 10 months consolidation breakout seems to be augurs well for next few quarters on the higher side. So auto index looks positive. Apollo tire again, strong base formation at 52-week EMA, falling trend line breakout and supported by strong volumes. Again, we believe Apollo tire is one which should definitely be on your portfolio for target of around 516, a stop loss of around 419. Apart from Apollo tire, hotel space is looking positive from the current market price, where Chalet Hotel remains to be a top pick. Again, Chalet, strong base formation, stock has seen a good correction and forming a support at the lower end of the rising channel post-COVID lows. So Chalet is something which we like for a target of around 1115, keeping a stop loss of 995.
Okay. All right, that's the take coming in on select hotel counters. And yes, like Snehi was mentioning a while back, that the hotel counters are doing very well, and our technical experts also seem to be liking that. But along with that, Rahul, what do you make of the whole life insurance plays as well? Because just yesterday we have seen a bit of a move coming in, of course, backed by the news that for the individual insurance, the rates can be now down to like almost nil. But along with that, we were just speaking to the Niva Bupa management, where they were highlighting that they do expect that overall customer base is expected to increase, but ITC, input tax credit, can hamper them in a bit of a negative way. What's your own sense on insurance?
So I think if you look at the entire life insurance as a space, I think with the we've seen the trend that first entire financial sector has done quite well, followed by banks, NBFC, and then the insurance companies. What we've seen. So my sense, I think the numbers are pretty good for most of the companies. For and the top of the bat is obviously SBI Life. I think the numbers have been pretty good for it. So for the current quarters, but the guidance for them, most of them, is I think single-digit growth for the FY27. So looks like I think it's a good portfolio stock to own it, and most of them have the valuations factored into it. So maybe as an allocation for a portfolio, one should look at buying for 15-18% a return on the stock. So the top of the ideas, what we like is SBI Life, HDFC Life, Neo Bupa. These are the three top bets on the life insurance place.
Okay, since we're talking about, the insurance plays, the group of ministers on insurance did submit a proposal to exempt life and health insurance premiums from GST for individuals. In fact, the proposal will be reviewed by the GST Council as well. And we chatted with Ankur Kharbanda, the ED and Chief Business Officer at Niva Bupa Health Insurance, discussing the impact of this move.
Proposal of GST exemption on health insurance is a welcome step towards improving, the affordability, and it will also support wider adoption of health insurance in India. Removing GST will immediately lower premiums and will drive a lot of demand, especially for the first-time buyers. It's important to note that the complete exemption would also mean we will lose income, input tax credit on the operational cost. So the benefits to the consumer will be therefore on the account of lower GST, less some loss of inputs credit tax. But it's a great move for our consumers, and especially the government saying insurance for all by 2047. It is in that direction. A lot of people who feel health insurance is not affordable. 18% is sizable. It's almost 1/5 of the total amount. So it will be sizable. A lot of first-time buyers will be there. For the existing consumers who already have, they may also want to upgrade themselves to a better cover, adequate cover, which they were not taking earlier because of premium. And last, I would like to say is that GST exam would also make OPD services more accessible to customers, because OPD-based covers will now become affordable and encourage people to use insurance for every day.
All right, so that's about the insurance space, but let's also touch upon the pharma space right now, because the news that we are picking up with respect to the EU and US deal that was announced in the joint statement that was released yesterday, wherein the cap of 15% for the drugs originating from Europe has been announced, and this seems to be a little bit of softer approach to the pharma tariffs overall. Well, of course, there was a threat of that 200 to 250% of the tariff that could be likely. But how do analysts see this is that the EU and US statement appears to signal a softer stance by the US administration on pharmaceuticals tariff. Now, while earlier discussions did hint at imposing higher duties, but the statement does provide a clarity for the European branded pharmaceutical players, and especially some of those drug makers with respect to the CMOs and some of the generic companies which do have exposure to Europe. They could be a bit of a beneficiary here, and case in point being Sun Pharma as well, because they have their specialty drug exposure to that particular market. Now, the US administration has exempted the generics from the tariff so far, which too is sounding a bit positive for the Indian players, and this policy seems to be continuing as well. So Rahul, wanted to have your sense on this particular statement, and what could it really mean for the Indian players right now? Because yes, of course, the overhang still remains, but do you believe that this particular news can be taken positively by the markets?
So I think overhang will still remain, I think, and this might give some kind of a breather or maybe a thought process of that I think that the tariffs, what we've been talking about in the pharma space, will not be as high as what the street or the most of the people in the streets are thinking at. So I think looks like positive in terms of a near term, but the overhang will still remain. But the larger players like Sun, Dr. Reddy, and all, and Cipla and so on and on. So I don't think so they'll have a larger impact in near term and for this time, but we'll have to wait till the time that entire tariff structure is announced by US.
Just looking at the market construct, of course, there will be a lot of stock movers. We're going to be looking out for the entire capital market theme as well, given the crack on those stocks here. yesterday. Everything from a BSE, Angel One, MCX, these were all stocks which did see a fair amount of crack. And let's see whether they get any, rebound or not. You can see slight bit of that rebound play out, at least in the pre-open rates. What about BSE? Because that's where the hardest fall or the crack came by. An 8% fall on the stock yesterday alone. And now BSE is perking up a little bit, up about 1.5% as we speak right now. Dabur also saw some profit taking, Idea, etc. were also some laggards. But yeah, Mankind, Cipla, Titagarh, PGEL, these were all stocks which were fairly buoyant in trade yesterday, as opposed to, of course, some of the financial giants like in ICICI Bank and Bajaj Finance also, which held out smartly. But it seems like we're headed in for an absolutely flat start once again. Rahul, what trigger will the market pick up on? And do you think now it's only the tariff clarity which the market would take direction from?
So I think rest, as I've mentioned earlier also, I think the most important thing is what we're going to announce on 27th and how it's going to take forward for that. So I think that's going to be the important event in a near term. So, and rest, I don't think so could be anything, any major trigger. And post-tariff also, how steep it is, whether this additional 25 is going to remain, and is there any relaxation in that? That's going to be a key thing to it. If the 25% earlier, which was levied, the basic one, if remains, then I think the markets have held it, and I think we're going to move higher post that. But if not, then I think we'll see more volatility coming into the markets.
Well, yes, all eyes are going to be on that announcement coming in from Donald Trump on the 27th and, declaring the fate of tariffs on India, whether it's 25, whether that additional 25 gets applied and makes it 50. All eyes are, of course, going to be on the 27th for more clarity on that. But Rahul, Dharmesh, coming to you for your mid-cap idea, what's looking good from that end of the market?
Yes, definitely. If you look at the mid caps, I think so that seems to be more for currently stock specific. But the way the formation seems to be forming for most of these mid caps as well as small caps, it looks like maybe they into the more for base formation. As I mentioned last time also on your channel, that maybe it's a more for shopping time right now for mid caps. Maybe the major trigger or a breakout we're expecting in the month of September. So yeah, it's more for stock specific. As I speak, that hotel space is one, I think so that looks more positive. Apart from hotels, metals is something, or some bit of a banking, I think so. I would say the small size banks, PSUs banks are the ones, I think so. One should definitely look out from the current levels.
Right. Okay, let's tell you what else is happening in the world of business, and the much awaited Jackson Hole Symposium has kickstarted. All eyes, of course, are on the Fed Chief Jerome Powell's key commentary as he's expected to discuss the path forward on interest rates. He's likely to address proposed changes to the central bank's framework for economic analysis. Also, US and European Union announced a framework for their long-discussed trade deal, laying down 15% tariff on EU exports. Remember, the framework reiterated that EU will purchase $750 billion worth of US energy and invest at least an additional $600 billion